Hello, so let me present this research about capital maintenance and corporate sustainability. So let me share my screen, my slides first. So this paper is about financial accounting, which is unusual regarding corporate sustainability, because as you know, most of the debate is about integrated reports or sustainability reports, things that are especially designed for corporate sustainability reporting. But in fact, about company law, most of the regulation is based on financial accounting. And so it would be interesting to reconsider financial accounting from the viewpoint of corporate sustainability. So, capital maintenance, this is the traditional concept that addresses corporate sustainability in financial accounting, and it answers the necessity to prevent corporate capital reduction by excess dividend distribution or other aggressive equity transactions like stock buybacks. This is the traditional view of capital maintenance. This is what is same in most company law systems in the world. And today I'm going to explain the origin of this rule and how it's related with corporate sustainability, and also some different variations that we can find in time and space, through time and space. So the concept of capital maintenance is much narrower than CSR indicators that are used in sustainability reports. But unlike them, it impacts corporate performance. And that's the very big difference between corporate sustainability reports and financial accounting capital maintenance. So today we'll first introduce the development of capital maintenance, and then I will raise a few issues regarding group reporting, definition of capital, and the regulation of shareholder transactions in Japanese company law. So this is the content. And let me start with the history. So in the 19th century, capital maintenance was borrowed in accounting from company law. And the concept of legal capital was the basis of the original capital maintenance concept in accounting. And at that time, accounting was more conservative than now, because the assessment of net worth was based on liquidated value, on current value. And so the net assets, the increase or decrease in net assets, would constitute the amount available for dividends. This is for the 19th century. And in the 20th century, the stock market developed in several countries, and also the size of companies grew, so that the accounting system also changed in the 1920s, 1930s. And in the 1930s, the focus of capital maintenance changed from the net assets to the distinction between capital and profits. This is still the case today. The correct measurement of profit is considered as the key to capital maintenance, because it's the way that you separate the earned surplus that are distributable from the original capital, which is not distributable. So this is the current concept of capital maintenance in most company law regulations. A little later, there was inflation and new concepts of capital maintenance that were created mainly to reflect the adjustments on the price levels. So this is not a very important conceptual change in the concept itself, it's just a response to the inflation. And in the 1990s, there is an interesting change in accounting that I guess many people know. The accounting standards focused more on fair value and what is called the asset liability view. And in the asset liability view, there's a very similar concept of capital maintenance with the original concept of legal capital. except that it's not based on the legal capital itself, but it's based on the measurements of legal capital from an asset liability view. And based on this fair value adjustments, the concept of profit is broader than the net profit in the traditional concept of capital maintenance, which creates some uncertainty about the amount that can be distributed as dividends and the amount that has to be maintained as capital. Last, there is a new concept of capital maintenance that is not yet settled, that is just starting to be investigated, and it is a concept of capital maintenance based on social and environmental capital, so based on CSR theories, but it is still very new, and there is no settled theory at the moment. So if I summarize these different views of capital maintenance, the decision usefulness view would be based on financial capital maintenance with stock-based measurements. So this is the kind of capital maintenance that would be found in IFRS reporting, with the reporting entity as groups. And in this view, the purpose is to provide information that is useful to investors' decision. So this purpose is from the conceptual framework of the FASB IASB. And this is an issue for European accounting standard setting bodies, since in the past the German accounting standard setting body and the French accounting standard setting body have clearly disagreed with this information usefulness view. Anyway, it is the mainstream for the IASB and FASB conceptual framework, also for the Japanese conceptual framework. And there's this is what is set as the main purpose of financial reporting for listed companies. The second view is, in fact, the traditional view in company law. So I'm not going to go back to the detail, but technically, the stewardship view is based on the correct measurement of profits, and this is based on a flows approach. The difference is that this stewardship view addresses not only the shareholders, but also the creditors. And a third view is what I said that was not yet formally defined, but most of the research would tend towards a flows approach of capital maintenance with a larger concept of capital. So in the corporate social responsibility view, the purpose of reporting would be to inform all types of stakeholders and prevent abuses. And the disclosure would be based on parent companies' disclosure. So these are three types of capital maintenance. At the moment, the stewardship view is what can be found in most company law systems in the world, and the decision usefulness view is what is used in financial reporting by listed companies. So just a word about the parent company's responsibility and why parent companies should disclose information about capital maintenance, not only the individual companies. In fact, there is a very big mismatch in reporting at the moment, because most of the financial information and disclosure obligations are for groups, while the legal responsibility is mainly individual entities. So the problem is, are parent companies legally responsible for the unethical or unsustainable behavior of their subsidiaries? Maybe not at present, but it would be worth reconsidering at least the accountability of company groups. The accountability, it means that groups should be obliged or should be regulated in a way that they disclose some policies at group level. Okay, this was for the reporting unit. Next, let me move on to the concept of capital. In fact, there is a very big issue. There is a big issue with IFRS standards, which is that the concept of capital, like for example shareholders' equity or even owner's equity, is not defined in IFRS. Similarly, the concept of net income is not defined neither. So this is a very big loophole regarding capital maintenance, because if you consider that you want to implement capital maintenance based on group accounts, there is no concept of equity that is clearly defined at the moment. In Japan, this is not the case because there is a definition of shareholders' equity and there is a definition of net assets. So net assets, this is the difference of assets and liabilities. It's like the 19th century concept. And shareholders' equity is the portion that is owned by shareholders. One example with Nissan. This is a Japanese company, but their reporting is very clear. So I use this example for IFRS and Japanese type of reporting. So, for example, this is the net assets part, and in net assets there is some portion that belongs to shareholders, which is shareholders' equity, with contributed capital, earned surplus, treasury stock. And there are some adjustments because with reporting that is based or partly based on fair value, you need to adjust the value of assets and liabilities. And these adjustments would be, or they are accounted for in this part for Nissan. And this is called total accumulated comprehensive income. This is unrealized capital. Below this other comprehensive income, there are some adjustments related with shareholder transactions. So the share subscription rights for Nissan, they do not belong to the current shareholders, but there are some amounts that will be included in shareholders' equity if the subscription rights, are exercised by the holders. Non-controlling interest is the minority interest. So you can see with this example that it's possible to separate owners' part and adjustments and other types of shareholder transaction and minority interest and net assets. This is possible in the frame of IFRS because there is no definition of these categories in IFRS. And it would be interesting to create a European regulation on that matter. Okay, so about the Japanese regulation, I picked up two issues because the Japanese company law has a lot of particularities and a lot of specific features that are interesting regarding capital maintenance. And I just picked up two issues. The first one is stock buybacks, and the second one is dividend regulation. So Japanese company law, it was originally based on the German commercial code, but it became very conservative in the post-war period. So for example, the pure holdings company were banned because of the zaibatsu. These are the cartels of Japanese companies that collaborated in the war effort. So the holdings companies were banned. Also, there's a lot of legal obstacles to restructuring. You cannot lay off people. And also the accounting standards are very conservative. So it's a German model, but more than the German for conservatism. In the 1990s, the Ministry of Justice started to deregulate company law after the last decade or during the last decades. And in this deregulation efforts, there were a lot of reforms about treasury stock, corporate governance, and dividends, etc. So about treasury shares, stock buybacks were almost forbidden until 1994, and it was gradually allowed in 2001 reform. So now it's allowed without restriction, but in practice there's almost no share repurchase on the Japanese markets because it's seen as a way to manipulate stock prices. The only exception is for large, I would say, innovative or companies that are called the new entrepreneurs, the SoftBank, Rakuten, and all the IT companies. So about the dividend limitation, there's an interesting particularity, which is the double dividend limitation. So in Japan, because the system was based on the German commercial code before, the dividend limitation was traditionally based on individual accounts. But in 2002, when the Japanese company law introduced consolidated accounts in the framework, they introduced also a system of consolidated dividend at the same time. And this is only for listed companies, so large companies that have some disclosure requirements that are precise enough to set this kind of limit. And this system is optional. So if a parent company opts for consolidated dividends, the limitation of distributed reserve is based on the minimum of consolidated amounts and individual amounts. I mean the reserves of the parent company and the reserves calculated at group level. And this system is more conservative than the original limitation of individual dividends because it has to be the minimum of the consolidated accounts and individual accounts. But for companies that opt in this system, there are some simplification of procedures regarding intragroup restructuring and intragroup stock acquisitions. For Japanese companies, intragroup restructuring was a very big issue in the 1990s and in the years 2000 because there were a lot of subsidiaries that were unprofitable and they had to merge the subsidiaries together in order to save the group. So this simplification of procedures is an interesting reason for adopting this system. However, the limitation of dividend itself, it cannot be seen as a deregulation reform, while it was intended at first at deregulating this part. The second advantage of adopting the system for companies is that they can prove to creditors that the company is very conservative regarding dividends. This is very different from what Western companies want to show to their investors, like we are more flexible and we give back the cash invested by investors as soon as possible. But in the Japanese culture, companies are very conservative. So adopting the consolidated dividend is a way to show that you are not going to give out all the cash of the company at any time. Okay, so let me conclude. Capital maintenance, especially as we have seen with the Japanese case, it is related with the purpose of reporting. The Japanese are more conservative because the purpose of reporting is to show that the company is managing cash and managing their investments very prudently. And for company law, it is possible to adjust the purpose of reporting. At the moment, company law is mainly addressing creditors and shareholders, so the rights of the owners of the company and the rights of the creditors of the company. But in the future, if we want to take into account the corporate sustainability, we can change the purpose of reporting for company law. So in the sense of more sustainable objectives, the first point that could be addressed is the reporting units. And in modern setting, the reporting entity should be groups rather than individual companies. Also, a second thing to do about financial reporting would be to define the concept of capital and define it in a way that is autonomous from net assets, so that you can identify the adjustments that are made to the concept of capital. Okay, and last, the limitations of dividends and limitations of stock buyback should be consistent with the objective of reporting and with the business environment. So there is a big debate whether dividends should be regulated or not. It's not only in Europe, but many countries. If the purpose of the regulation is to retain cash within the company, then you need a clear concept of capital and a clear regulation or a clear way to regulate the dividends that can be paid compared with this capital. Okay, so that's it for my presentation. Thank you very much.